Good afternoon, traders. This is Christian from Tropic Trade Group. This is your end of day and end of week video, market video for Friday, December 3rd. Risk disclaimer in front of you. Everything that we're going through is for information purposes only, not giving out any advice or recommendations. The video is for education purposes only. And if the screen's a little bit blurry, it's just because YouTube takes a little while to render the high definition version of the video. So let's get right into some of the themes. And this will be a shorter video because quite honestly, I think it's good to kind of get away from the screens after a week like this. The performance for the week, after, remember, we saw a bounce and we've seen a bounce a couple days this week, but the bounces have been kind of short-lived. But here's the performance for the week. SPY finished down 1.3%. Small caps got hit again pretty hard, down 3.7%. Qs down 2%. The diamonds, which definitely fared better, right? The Dow stocks finished down less than 1%. Interesting there, emerging markets finished up for the week, right? With all the move down in the China names, well, they kind of got balanced out a little bit because China, which is a big portion of that EEM ETF too, that finished positive for the week. Big move by bonds this week. They were up 2.5%. Value versus growth. Growth got hit pretty hard this week, down 2.3%. Looking at sectors, those home builders that we talked a lot about in yesterday's video, they were up 2.6% for the week. Utilities, utilities, semis were your other areas of the market that were positive. There's the Chinese. So again, remarkable. Chinese internet's down 12.5%, but EEM, I have to kind of look into that to the performers for the week. But for the week, the Chinese internet names were down 12.5% for the week. Clean energy, pot stocks, solar, blockchain, FANG internet down all over at least 7%. Some of those areas of the market down over 10%. So pretty nasty. And I mean, here's probably why you see emerging markets, some of them being up, smaller areas. South Africa, that ETF, despite being in the news all over the place, was up 8% for the week. How about that? Russia was up 4% for the week. Mexico up almost 6% for the week. Right? And then you have a couple of these areas. The FXI, wow, look at the difference between FXI and the Chinese internet ETF. One was down 3.4%. One was down over 12%. That's remarkable. All right, so let me get to, like I said, I wasn't going to spend too much time. This isn't going to be a super long video, but, I just wanted to kind of talk about some of the factors that I'm looking at, and we'll delve into this in much more detail in the TTG weekend macro video. Right? I usually do about a 30-minute video on on all the factors, and then I circle back and kind of give you my how much. My risk rating for the overall what I call investment landscape. Last week I dropped it down to low, but I will go through all the factors. I just wanted to talk about maybe two or three here, and then I want to just review the S&P chart and a couple takeaways, and just some thoughts about when we get this higher than normal volatility, which the VIX, did not close on the absolute high. The VIX, it got up to a 35 today. It did come down to finish the day right around a little bit above 30, right? So I think 30.6. So let me start with a couple factors. One of the things that I've got written down here, and this is what we do in the macro video on the weekend, is we do look at about a number of factors, right? I call them, looking at some of the market internals, looking at some things under the hood, maybe some factors outside of equities too. We'll talk about credit spreads. But for the most part, price and trend are the most important things, right? We could try to get some clues off of some other things, but price rules, right? Price is never, is not wrong, right? It's going to that's going to judge your P&L. It's going to judge your performance, right? You can't argue with price. I don't care. I know some people think otherwise, but this is, my take, and price is always correct, right? Sometimes price is perfectly efficient, right? And all the information is in there. Sometimes it's not. But at the end of the day, that is our scorecard, right? is based on what those prices are ended up doing, right? Opinions don't count, even though some people like to be super confident, have a big ego. We'll talk about that in a second. All right, so let me talk about a couple of these factors, right? So let's see, what chart do I have first? Let's talk about credit spreads first, right? I think this is like, to me, this is a good thing, right? We're not seeing credit spreads jump higher, like doesn't like. So if you go back, I'm going to compare. I don't want to. So let me, my disclaimer before before I do this is I'm going to look a little bit at the chart of this, the big move that we saw in March of 2020, right? Almost 2 years ago at this point, right? It'll be two years in a couple months, right? And I'm going to go through the equity chart, and I'm going to look at a couple things like, I'm going to look at the VIX, right? And I'm going to look at credit spreads. So right now I've just got 1 year, which isn't going to tell you too much, but let's go back 2 years. All right, so this was the big move up that we saw, and this started to happen in February, where credit spreads started to jump, right around 221, right, 221, and then they really started to move towards the end of the month of February, and then they went berserk basically for just about a month, right, 323, maybe a little more than 3 weeks, right. So that's what happened, right. So right now, they started to move from the lows, but we're not seeing that same type of action. Right. Again, why are credit spreads important? Right. They're telling you if there's any major concern in the fixed income market. Fixed income market is larger than the equity market. Right. There's a lot of stuff going on there. And usually, if something really bad is happening, it shows up in that fixed income market. All right. So again, remember that date I talked about, right around 220, 224, and then at the end of the month. Okay. So let's look at the VIX now. I'm just going to so let me move over to a different screenshot. Here, I'll move this screen over. So the VIX. All right, which again is just, if you're not familiar with what the VIX is, I know it gets misinterpreted, but it is just measures the short-term implied volatility of the S&P. That's all it does, right? It doesn't do anything else, right? People think, oh, it's the fear index. Well, that's not really the best name for it. But so let's look at 2-year chart. Same thing, right? So this kind of went up in tandem, right? Look at 224, big move here. Let's go up to the end of the month, right? Right. So this was they were doing the same thing, right? Between credit spreads, they were widening, right? When credit spreads blow out, they widen out. That indicates risk. The VIX is indicating higher risk, right? Higher volatility, right? So that happened too. Right, so that's a couple things to kind of note. Now, if we look at equities, so I wanted to kind of compare this. I'll get back to the 1-hour chart just for a second, but I want to draw back. Right, so right now, what we have going back and forth here in the S&P, we did not hold the 50-day moving average. Right, we've seen this before. It has been a rising 50-day moving average where we broke this back in September too. So keep that in mind. And but right now, price is. So I know this is difficult to see because I don't have these as very thick lines, but we're below the 50-day moving average. We're also below the 20 and the 5-day moving average. Notice that where we closed, I'll try to highlight this 5-period moving average. The 5-period moving average helps me a lot. When I see price below it, right, when price can't get back above it, like if you look at yesterday's candle, for instance, right, nice bounce. We talked about how value names really outperformed, but we could not get above that 5-period moving average, right? That means that there was no change in trend, in the short-term trend, right? And that's kind of what I like to look at whenever we're trending, right? So take, for example, most of October. Look at how price stayed above the 5-period moving average the whole time. Well, now it's moving down below. And I think that's important, right? And what I've learned over time is to try not to anticipate and try not to come out with opinions that are different than what the price action is telling me. And right now that we know that the price is in a short-term downtrend, and we have not been able to get above the short-term 5-period moving average, right? So that is down. All right, so again, purely looking at price. Let's go all the way back. So let's go back to that time back here too. So notice that this started to break down, right? It's around the same time. So that was kind of like, some of those things that I've mentioned already, the VIX, credit spreads. They all started to make their move around the same time, right? And this was a move down to basically we paused here for a little while at the end of February, and then we kind of hung out a little bit, and then we dove down again, right? So it was a little bit gave a fake out looking at that 5-period moving average again, but so if you got faked out here a little bit, and I remember I got a little bit faked out, but once we started to dive, right? So I unwound risk, I got a little bit back involved here, and then I had to unwind the risk again, and then I basically just sat this out for the most part until we started to see, not only the price and the indices such as the S&P get back above the 5-period moving average, but going back to that time frame, if you remember, we started to see a lot of things improve in terms of single names. And I think if you've talked to a lot of experienced traders back then, they noticed the same things too. Like things like Tesla, right? That bottomed before the overall indices did. So we're not going to get into single names here in this video because, like I said, I want to keep it short, and we'll go over that on Sunday for the member video. But that will be something that will be telling, right? When we see more and more positive, like good-looking setups, even though the indices are still going down, that's a positive sign. That's a divergence as well. So we've got some similarities right now, and we've got some differences, right? We don't see credit spreads violently going higher right now. So that's a good thing. So that's a difference between what we have. But there's just not enough information, in my opinion, to make a lot of conclusions based on this, right? Because until now, so we stayed, once this happened, we stayed below the moving averages, specifically the 5-period moving average for another 2-3 weeks, all the way to in here. Once we got above it, that was pretty much it. You had a little bit of a setback here, but it just started to look much different. So that's what we're going to want to see, is price to get above that, and then even better, get back above the 20-day moving average, and so on and so forth. But we're going to be able to figure that out once we kind of look at what some of the single names are doing. So it's too early. I know that we got this nice little bounce at the end of the day. Could it be short covering? Sure. Could it be people were buying the dip a little bit? It could be, but it's really difficult to say, and especially when you're dealing with the VIX coming off from 35 to 30. That's somewhat positive, to me, that we didn't finish up here. But we're still, this is elevated, and this is also closed above the 5-period. If you notice, use the same analysis, it closed above the 5-period moving average. The trend in short-term volatility, while it closed off the highs, is still up. So that to me is, try to sit on my hands as much as possible. I do take some small shots here and there, and that's the name of the game, is to not get, right now, for me, is to not get overexposed, right? I could take a shot at a couple things here and there, but if I have to take them off, as I've gotten stopped out in a number of trades, I don't want to have it to mess with my confidence, right? And mess too much with my overall mindset. And everybody's different. If it messes too much with your mindset and it really starts to bruise your ego or your confidence, then maybe just sit on your hands, right? Others are really good at trading to the downside and being able to trade a high volatility environment. It all depends on your game, basically, and your personality. So the bottom line is do what you're comfortable with. But if you agree with some of the things that I mentioned, right, it's in my opinion, it's better, like if you're trading mostly to the long side, it's better to just to sit out as much as possible, right? You're not causing yourself major stress. You're staying fresh. You're staying nimble. That's my goal in any of these situations that we're dealing with. All right, so that's a little bit about mindset. Again, I don't think I could really make too many conclusions. Were there some bright spots this week? Sure. I think those home builders were very strong. Lennar, I actually started a position yesterday, but I bailed on it today with the volatility. But I think it looks okay. And I have no problem getting out of a position and going back in. I did this like 2 or 3 times with microchip, MCHP, right? It did close above value, so I added it back at the end of the day. Now, if it drifts back and goes back below like 84, I'm out of it, right? And a couple other trades too. Sometimes I'll go into a trade if the price action is not confirming what I'm looking for, I'm out of it, right? It's just that simple, right? Again, I have opinions. But really, ego is something that we don't want to have interfere, right? How many? Well, I don't want to go off on a tangent about this, but fund managers, right? ETF. There's certain ETF fund managers that are in the headlines right now. Let them do whatever they're doing. You don't have to invest in their funds, right? That's not really our job. If you really want to judge them and so forth, you can, and we do that about how certain fund managers are trading and so forth. But you don't have to follow any of that stuff, right? Let them deal with their own issues. But keep my job is to keep my ego out of this, right, and not get caught up in being stubborn and so on and so forth. A couple other things that I'm watching too. Right, the put call ratio. Right, I mentioned this last night. I also mentioned it in the pre-market session as well. We finally got like a high level, a higher than normal level. Now, if you look at the 5-year, it's not that. It's much lower than it's previously been in other years. But you have to remember this year, going back to 1 year, we've seen turnarounds happen on these spikes. So I would assume that this is going to be close to this, maybe even higher today. I don't have the data from the SIBO. Sometimes they release it at 8 o'clock at night. Sometimes they release it at 10 o'clock at night. But that I'll have it out, obviously by tomorrow. Again, I tend to look at the equity put call ratio, not the overall put call ratio, which is much higher. You could do whatever works for you. But so there's definite fear in this market now with the VIX over 30, with the put call ratio, and a lot more put buying. So that is setting up for perhaps getting this selling pressure out of the way. But that doesn't mean that the institutions are done selling, right? Today we did see an MOC. I don't know if it was because Friday or something else. I think it was the first day this week that it wasn't a heavy MOC for sale imbalance. So maybe these institutions are getting to the point, are getting close. But we don't. Again, I'm not saying that they're done selling, but that is who's doing like $4 billion at the end of the day, $8 billion I think we saw at the end of the day, right? That's heavy institutional selling, right? So that needs to, at some point, they need to finish doing that. And again, we can't kind of predict these things. But the way that I'll leave this is, though, that a lot of times this happens like a seesaw, right? One name that we saw some call buying. I said I wasn't going to mention too many single names here, but for instance, one name that saw some call buying at the end of the day was ServiceNow. What happens is when these prices really start to fall in some higher quality names, they become attractive, right? And people don't want to sell them anymore. They actually want to start buying them, right? So that's the whole name of the game is are we there yet? We don't know yet. We're going to do some more analysis, a lot more analysis this weekend. But the name of the game is being for me, again, is for being patient, not giving back or trying not to give back much of my P&L. I lose money on here and there on days like this where the volatility is like this because I'm mostly playing to the long side. I had some thoughts about playing things to the short side yesterday, but I didn't really short anything today. I missed the boat on that. So my goal is to really just not give back much much profits as we're doing this. Sit on my hands, be patient, and wait to kind of jump and be, when we start to see things turn around and we're getting the green signal to get more aggressive in the market. All right, guys, that's it. Have a great weekend, and I'll see you guys. I'll see the members for those videos on Sunday. Thanks, guys.